Welcome to the Rachel and Cassandra Show. Before we begin, our disclaimer. What you are about to hear is not even close to legal or financial advice, even though it might sound like it.
Happy day, everybody. Thanks for joining us. We're a little different today. If you're watching, Rachel's at home. I always call in, but she's not feeling very well. So if she sounds like a frog at times, she's not trying to.
Ribbit. Comic relief. Okay. We have a pretty meaty topic today that is really going to be, I feel like I should just pass the mic right over to Cassandra. Our topic is
what?
Yeah. Do you want to just run with it, Cassandra? Our topic is relevant all the time, but specifically today is probably going to talk about what's happening in the real estate market today.
Yes, this is pretty relevant. So whenever it even goes out, just know that it's relevant. This is recorded January 7th, and I'm going to tie 2022. So when it comes out and is dropped, it's still relevant in the same way some of the data I'm telling you is. This is a super internal. So I'm going to go off the bat, right?
Yes.
Interest rates, how they affect purchase power and home values.
Yes.
Just like how this is recorded the 7th, all the interest rates I tell you for the average are current today. I also would like to point out that when you see the published rates that I'm talking about today, they're actually valid for last week, right? In the same manner. I know.
Okay.
So
crazy.
First tip is when you see the interest rate, right, that is posted, the rates are published every Thursday for the average rate. However, all of that data is collected on Monday. So
you are talking like such a loan officer right now. Can I just ask? I know. So can I back you up? I'm going to talk you down. Talk to me like I don't know what you're talking about.
Look at how much number data I have to talk about, Rachel.
I know. I love you and your numbers. But if I'm an average consumer, are these rates that are published that you're talking about something I would see or something a loan officer would see? Like who sees these published rates?
All right. If you Google mortgage rates, because I swear to God, people Google mortgage rates to see if they're getting a good rate, right?
Sure.
So when you find the rate and it's the average rate, now it says the average rate is 3.221. Well, that was true last Monday.
Oh, I see.
Today's Friday. That was true last Monday. Do you want to know what a bloodbath this week has been? I wish I could price at last Monday's pricing. That'd be fucking amazing.
Oh, so the prices are different because it was Thursday yesterday.
Right. And so the data starts becoming antiquated really quick and the market moves very fast. We've had in the last 3 days, right? So all this week, it's been a disaster. Yesterday, I had 3 reprices for the worst. The day before that, I had 4 reprices for the worst, which means interest rates are going up.
Boom. That's what I was going to ask. How does that matter to me? What is a bloodbath? Why would you have one? Maybe you were shopping and you didn't lock in a house and you didn't lock in a rate because you didn't start the formalized mortgage process. Yeah.
Right. Yes. So if your interest rate is floating, just do yourself a favor, call your loan officer and say, I need you to lock that. There are a few instances where you might not lock it, but generally speaking, rates have been going up. And I have some data that goes with it in terms of retrospect.
And can we talk about why they've been going up? Or I know first we have to talk about why does it matter if your rate goes up?
Yes.
Like how does that impact your purchasing power?
So for ready?
Yes.
For every 1% increase to the interest rate, your buying power goes down by about 10%.
That makes sense.
I have so many examples and I'll get all muddy and you're going to have to keep me on the fucking straight and narrow
job.
sis.
I've got the lasso. That is my job. Let's go.
Okay. So
go get them,
when
cowboy.
rates rise, right?
Yes.
Your buying power typically goes down 10%. We're going to couple that with a 16% increase in home sales, in home value, home
Values.
prices year
Yes.
over year. So home values have gone up, the sales price has gone up 16%, right? But rates were really low. So it wasn't that big of it wasn't like, oh my God,
Right.
people weren't getting priced out of the market. Super low rates.
Yep.
Houses are a bit more.
And when okay. No,
Go ahead.
I'm sorry. I'm taking crazy notes because what I'd like to do, because your concept, I can see clearly where you're going and I love it. And what I'd like to do is break it down with an actual $300,000 purchase price.
I did $300,000 purchase.
Fucking
Oh my God! I already have the notes done. I already have it.
All right.
Okay.
Love it. Math has been done.
Rates are going up 1%, right?
Yes.
Which means your buying power is going down 10%. Home
even if nothing else
prices,
changes. Literally,
even if nothing
no
else.
other
So that's just interest rate. But home values have also gone up 16% year over year between 2020 and 2021. They are expected to go up another 17%. Oh, we're going in the, it's getting kind of more expensive to buy a house, obviously. And do you want to know what the average household income increased year over year between 2020 and 2021?
0.2.
Oh,
Did it go down?
2.3. 2.3. So when people say there's no homes, I can't afford a home, they are absolutely not lying to you. Their income's gone up 2.3%. The price of a home has gone up 16.6%, if I'm being very specific. And this is old data. This is August to August 2020 to August 2021, but it's still trending upwards, right?
Yep. And their buying power has just now dropped 10%.
Exactly. Just this, thank you 2022, right? It's been trending, but this year's been pretty gross.
Well, this was the missing piece of the puzzle, like increased home values, decrease in inventory, high competition. All of that's been in place for a long time. And there has been this, what is the word? Cry wolf almost. Because for the last 3 years, interest rates might go up, and everybody's been kind of like, they've been saying that for a long time, and it hasn't happened, and now here it's happening.
Well, and the worst part is, so not only is it happening, but people still right? People are a little old to mentally
delay. There's a 6-month delay.
They go, rates are in the 2%, and you go, no,
they're not.
No, they weren't. The last time. Yeah. Okay, so do you want to know rates?
I do. What?
Nothing. Well, so I do also want to point out, just as an aside, there were 0 states with declining home values last year.
Yeah.
On top of that, there were 0 large markets, literally any city, right? That would generate data. I don't mean like a podunk. There were 0 large markets with declining home value. So even in states that people are fleeing,
values are rising.
Values are rising. Yes.
Yeah.
They're exploding in some places. Okay, so I'm just going to do a tiny little bit of rate history, right?
Yeah, please.
January 2020, 2 years ago, pre-COVID, the average rate on a 30-year fixed rate mortgage was 3.71%.
Yep, that feels
pre-COVID.
Right.
Today, not what you're going to find online. Today, the average is, not the published rates, because that was a look back to last week. Today's average is 3.608 on a $300,000 purchase with 20% down and the best credit score you can have. So we are nearing pre-COVID levels. Still amazing in the history of all the things, but people are losing their mind because house prices are so expensive and rates are now back up to where they were.
We got to slow this down. You said in 2020, the rates were 3 point something.
3.71, January 2020, just pre-COVID.
And then today's rates are 3.6 something. So how is that an increase in rate? That seems like the same, like nothing happened except for house values went up.
In December of 2020, it was 2.79. In September of 2021, it was 2.83. So we literally, COVID basically had rates drop almost a full percent, which means people had 10% more buying power. So it wasn't as big of a shock, right? Like it wasn't a humongous jump because you're like going, fuck, rates dropped 1%, which means my buying power is 10% more. Home values, right? Homes are selling for 16% more. So overall, it was like a 6% more expensive market.
So the effective rate to the home buyer, that gap was smaller because of the lower
cut in
rate.
half.
Yeah, more
Less than
really.
half. So it wasn't that terrible.
And I'm glad we're using real numbers because I don't tend to think about everything in percentages. And, my brain looks at something like 6%, and 6 is a small number, right? But on a $300,000 property, that's $18,000. And if I take away that boost from the interest rate differential, now I'm talking about $30,000.
And we're at compound interest too. So we won't, that's that separate conversation. Okay. So I did price out 30-year fixed rate. We're just going to vanilla it. $300,000 purchase with 20% down. That is not the norm for most people, just so you know. But
what is the norm for most people?
The vast majority of people do not have 20% down. You know who has 20% down?
Okay. So that's what I just wanted to make sure we're talking about a spectacular scenario, not the average person scenario.
This is considered the average scenario that you would probably find if you went on Quicken or Wells Fargo.
If you're shopping.
And you're just like, what's the rate? They're going to quote you a $300,000 purchase with 25% down, actually, to give you a little lower rate. So this is like the quoted rates, right? It's like the most vanilla, but it doesn't suit everybody. So
it's likely not what you'll end up buying.
Right. Or how it will be structured. Anyway.
Okay.
Because, it depends. Yeah.
I'll do it.
Okay. So 30-year fixed rate with 20% down with the best credit score possible. Today's rate is 3.608. So it's a $240,000 loan. Your payment is $1,092 just for the house, not taxes, not insurance, right? So $1,092. So we're going to test
principal and interest only.
Principal and interest. So we're going to test this for every 1% increase or decrease, the buying power is 10%, right? Say that's the most you can pay for a house. So if the rates go up 1% to 4.608, the payment's now $1,231. And if rates go down to 2.608, the payment's $962. So we are literally proving it's actually closer to 11%, but for every 1% rate, 10% to buying power, and it changes your monthly payment, obviously, as well.
What was the first monthly payment on that first interest rate? I didn't write it down.
$1,092.
1092. And what was that interest rate?
3.608. Today's actual average, not the one that's published from the look back of last week.
Wow. So you just went from, that is a completely different mortgage payment.
Well, so a lot of people get a payment in their head, right? So I ask people, what's your comfort payment? Oftentimes they go $1,000 a month, $2,000, right? They have a nice round number. This is my rent, not more than that. But say you have $1,000 a month in your head and rates have just gone up. Remember in September, in like 4 months ago, rates were 2.83.
And this is when you started shopping, and then you took a break because there wasn't any inventory, and then it was Christmas.
Yes. So you shopped and it was 2.83, and you were thinking your payment was going to be $960, and you find a house today 4 months later because rates have gone up just about a full %, and you're like, $1,092, you're $130 higher than you were. You're quoting me a rate almost a full % more, and I'm shopping around. Well, okay, I totally get it. I understand it.
Yeah.
But it's moved very fast this last week, and it's moved a lot. Like we went up a full quarter % this week alone.
Yeah.
And have gone up almost a full % since September.
And now let's bake in whatever incremental improvement in home values. So the starting price of the house that you want to buy is a little higher than it was 3 months ago.
Right.
That gap just got a little wider. And so not to go into a rabbit trail, but there's a tiny one. Absolutely. It's exponential. Well, now I'm thinking about things like, so from a real estate professional standpoint, I have to mitigate those things because I'm still going to find you a house. So now my mind starts saying, okay, where are the lower tax areas? Because your buying power, you could maybe buy the same house somewhere with a lower, your principal and interest goes up. So we can offset that by buying somewhere with a lower taxable rate, lower insurance. I can't really manage well to that, but
Right.
your
You
whole
want to
payment
look
would be
lower. So I talked to somebody the other day and she's like, we just can't find a house. And I said, at this point, right, we want to be in one of these two places, but the houses are,
the
it's
three
all
circles.
so, yep. But all the homes
Putting
are
up my
just
markers.
too much. They're just too much. And I said, I'm not telling you what to do. Find the shittiest house where you want to be because the value of the home's going up. If you think they're going to be cheaper in 6 months, you're wrong because now the interest rate is.
Boom. I'm showing my diagram. You can't see it there. That.
Now I can see it. Yeah. But just get the house.
Yes.
Because they're not, had she purchased a year ago, she's been looking for a year, she would have paid 16% less for the house and her interest rate would have been a full percent lower. So if they were priced out of their market, their desired market, then imagine how priced out of their market they are now. It's absolutely unattainable, which means you're going to have to go somewhere else. You're going to have to find a municipality with low taxes, or you're definitely going to have to commute.
You're going to have to adjust your expectation. And my mind is saying like, the point of this conversation, if you're listening, is not to try and say rates are going up, you should buy a house now. This is not a fire sale scenario. It's literally just trying to make that connection so that you understand the cost of your money impacts the purchasing power that you have. And there are, I don't know, elements that will impact how much you can afford that are outside of your control.
Right. How much you make, what your debts are. Those are things you can control. This shit, you are a slave to. We all are.
Well, and I have buyers that are, people try and game the system. They are going to wait until.
Don't say. We're talking about that next.
Yeah. Okay, good. And I want to take a minute. If you are watching, I held up this diagram. And if you're not familiar with our content over a long period of time, this diagram is real estate in a nutshell. Right. Shame on you. But I want to just explain it. This is what you're doing when you're buying a house. There are three factors at play. There is the purchase price of the property, the condition of the house, including the style. Is it Victorian? Is it a bi-level, tri-level, quad? Is it crumbling or is it pristine and brand new? All of that is in here. And then this is the location pin. I know it looks like something else, but it's a location pin, I promise.
Is it? Is it?
It is, yes. You only get 2 of those when you're buying. And there's only one of those that will never change, and that is your pin, which is why you have that old real estate adage, which is location, location, location. You can remodel the house always. The price will fluctuate up and or down throughout the time that you own it, and you can't see the future on that. So anyway, thank you for letting me get on my soapbox. Go.
So I wanted to talk, we were talking about interest rates, right?
Yes.
And how that changes your buying power. And then I texted you a little diagram that makes sense to people who do what I do. And it might have made sense to you. There was an announcement 2 days ago regarding investment properties. No, I'm sorry, not investment properties, regarding second homes.
Yes, which is distinct and different from an investment property.
Yes, I'm sorry.
Like our lake house.
Traditionally, you can buy a home as your primary residence. You get the best rate. You can also buy a secondary home and get the best rate. Like there was a tiny little price adjuster on it, but honestly, like it was pretty fucking good deal. So
especially when compared to an investment property.
Oh, yes.
Right?
Yes. So now, starting with loans delivered April 1st, which means every lender is a little different. It does take time to close a loan out, get it ready for servicing, get it bundled and sold and delivered, right? Which means starting in the next couple weeks, they're forecasting for their April 1st deliveries. And beginning then, second homes, it used to be a 0.25 adjuster, right? 0.25 of the price of the home, of the loan amount. Okay. 0.25 of the loan amount. So a quarter of a percent of the loan amount was what you paid, or you took a higher rate to wash that out. Now it's 4.25.
What the
It
heck?
4.25%. I'm going to go double check. Was it 4.25, 4.125? Let me go look what I sent you.
Yeah.
4.125% of the loan price is now the price hit, which brings second homes right in line with investment properties. And if you would like to shout from the rooftops why you think they made that change,
I think I know.
I would love it. I think you know.
Pick me.
You.
I'm going to guess. People are buying second homes and renting them out. Airbnb?
Yes.
That's my guess. Yay!
I suspect that.
Is that mortgage fraud?
Home, kind of. And yes and no. Because if you go and stay in it for a week, I mean, I guess it is a second home. But I think Fannie Mae and Freddie Mac looked at the addresses of some of the homes they did as second homes, found them on Airbnb and VRBO, and they were like, motherfuckers, fine, we won't do second homes anymore, which is basically what they've done. They've already backed themselves out last year of the investment properties. We talked about that. That's still pretty much the case. It's gross to buy one because it's supposed to make you money, right?
Yep. So now it's like borrowing. It's like buying stocks with your credit card. Kind of. You're borrowing money to make money. There's some kiting going on in there somewhere.
Yeah. You want it, your cake and eat it too. Don't we all? Fannie and Freddie finally went, what the hell? And I say Fannie and Freddie, conventional loans were the only ones you could use to buy a second home. FHA is primary only. Rural development is primary only. VA is primary only.
Yep, so those programs exist to get people into home ownership. Not to help you build a real estate empire of being a landlord.
Well, so in addition to this little like price adjuster for second homes, basically a big one of these to second homes, and I stuck my middle finger up, people. Ha, ha, ha. If you're listening. But they also put in there, they really want to support efforts with affordable housing, and they're not charging any loan level price adjusters for first-time home buyers with income less than it's the AMI, the area median income, which means that it's like they've shifted their focus just this tiny bit for home buyers, which should help. And I'm going to circle it all back. If people are not buying these second homes, right? Because it only took 10% down and you basically have an income operating. So Fannie and Freddie were like, fine, we're not going to finance those anymore, which should leave more homes on the market.
Unlock inventory.
Unlock the inventory because we're already short of inventory, which might help housing prices because this generation that's buying is gigantic.
But hold on now.
Homes for them.
And I know we already talked about this and I don't want to get deep into the weeds on it, but is it not also possibly removing the mom and pop, if you will, investor from the market and freeing up that inventory for your cash investment buyer over both the first-time home buyer and your mom and pop Airbnb-er? Possibly.
It perhaps is. Yes.
Interesting. Well, I hope your scenario is the right. Go.
We have talked about the big companies, the Blackstones, the Fundrises, acquiring the homes for cash.
Yes.
And I will say what we said, if you don't like that, sell it to a fucking human.
Yep.
Sell it to a person who's going to live there and enjoy the house.
I'm just saying policy often is written with one goal in mind and unintended consequences happen. So I hope that the intention is realized and doesn't create a warped opportunity somewhere else.
I agree. Yeah, because it basically, in order to get away from this horrific second home pricing, they're looking for an investment of about 40% down. And I think it becomes reasonable with maybe 30% down, which is a giant down payment, which let's be fair, doesn't seem very wrong for a second home. I mean, seems
I agree.
seems fair.
Yep. The skin in the game.
Yeah. Because which house are you going to let go first?
Yes. And
Primary?
I'm glad you said that, because I was going to hopefully walk us there eventually, so that, remember, behind all of this money are investors, and you are a risk. So when you're talking about your second home, if the shit hits the fan, you're more likely to pay for your house that you live in than to worry about that investment property that's not making you any money.
Or tenants that aren't paying because they haven't had to pay.
Mm-hmm.
But anyway, so as of today, January 7th, 2022, rates are rising. As of any day that you look up mortgage rates on the computer, you're looking at last week's rates, which may not always be correct. And for every 1% increase in rate, your buying power declines 10%, and your monthly payment increases about 10% from where it was. So it's very different now than it was 4 months ago. You can go ahead and shop around. I just had somebody say, "Oh, I've been trying to buy this second home on an island, and Chase has been dragging their feet. We finally got an appraiser out there. He had to take his own shuttle, right? And now they're telling me they won't finance it because of the remote access, and it's not available all year round." And I was like, "Well, that's Fannie Mae's rule. Try Freddie Mac, right?" This was last week. And he was like, "Well," I said, "I can take a look at it for you, right? I'll take a look at the file." Actually, I sent him the answer, and I said, "Send this to your loan officer. Freddie Mac will do this." And then this lender letter comes out regarding second homes and this giant fucking adjuster. The dude already had said, "I'd really like the rate that Chase quoted me back when I started in September." And I was like, "I bet you would.
Yeah.
It's a full percent higher." I said, "If you can still get that rate, fucking close with them.
Yeah.
And here's the way to do it. Here's the rules on how to do it. I'm advocating for you. I don't need the deal.
Right.
I just want you to close." And then this came out Wednesday, and I sent him a text and I said, "Hey, I'm not trying to fearmonger.
Yeah.
However, if you don't close here within the next 2 or 3 weeks, you're going to be shit out of luck on that rate you wanted. You're literally going to not." What happens when they put a 4.125% price hit on it is, say it's a $300,000 purchase, right?
Yeah,
it is literally $12,000 more due at closing just to get a shitty rate.
I'm so frustrated. I've got so many emotions bubbling up around the scenario you just gave. One, it's a guy buying a second house on a fucking island. Let's start there. That took me a minute to digest, but okay, good for him. Now he is bitching about I'm sorry, I shouldn't really project so much, but I do kind of feel like putting a healthy chunk down is not a terrible idea in that scenario. Do you think Chase knew this was coming and they're dragging their feet on purpose?
No, I don't know. They started in September, so it started with issues with getting an appraiser out there, getting him out to the island. It actually starts with a shitty fucking LO or a dumbass underwriter.
Yes,
is what it starts with.
Doing.
Because to go through the whole thing, get an appraiser out there, and then go, "We can't do that because there's not year-round access to the property." And I was
just
like,
now saying that? Fuck
they
you.
literally said it after the appraisal came back, after he spent good money finding an appraiser, getting him to the island. And then they come back and they go, "That place doesn't have year-round access. We can't do it." And I go, "Freddie Mac can do it."
Yep. And here's the
what the fuck, Chase?
So the fact that you're walking the client through helping their bank, and banks are not in the business of doing mortgages. They're not very good at it.
That's what I told them. I said, they are not known to want to do this.
They're not agile. They're not dynamic. They're not flexible. This part of the conversation comes down to a thing that I tell my clients, and I don't know, maybe it's weak, but here goes. The longer you wait to close, the more likely it is that somebody's going to die. And I know that's not what's happening here, but if you keep dragging out your fucking deal, the likelihood of shit going sideways He never would have anticipated this kind of double hit. And now his interest rate's going to be higher because of all this time it took to get the deal closed. Shit starts going sideways.
It's still not closed.
No. And now he has to. So I have a question back at the beginning.
I kind of feel bad for him. He's months into this process of really getting
he did what they said. Yeah.
Yeah.
But the April 1st deadline, is that he has to close by April 1st?
Oh, no. So I mentioned this before. You have to. So that's for loans delivered starting
to
April
who?
1st.
What does that mean?
Delivered to Fannie Mae and Freddie Mac.
So it has to close before April 1st to get delivered.
Way before.
Oh,
yes. At least a month before. At least a month before. Because so what happens is
by like March 1st.
I would say mid-February.
Really?
Yes.
He's got a month. Can you take this loan and push it through? Can you get that old appraisal?
I said if Chase will transfer the appraisal to me, I mean, I have lenders that will take it. They will. I've actually gotten them and Fifth Third to transfer them, but anyway,
make a case for it, a federal fucking case for it.
Yeah, you have to you have done this person fucking dirty and make a federal case for it. But I feel bad for him. He did everything right. He didn't know. I mean, he's not supposed to know the underwriting guideline. The fact that I'm sending it to the LO, whose response was,
the loan officer's supposed to know.
We underwrite almost everything through Fannie Mae, so I didn't even bother to check Freddie Mac. Are you fucking kidding me? Why do you even do this job? You don't do this job. You just take orders. You have to, whatever.
Yeah.
Whatever.
Take a breath. You're right. Yep. This goes back to the licensing conversation.
Yep. I have a license. Chase guy does not have a license. I have education. No education required.
Yep. And on that note, how do we even bring this home? Yeah. The best time to buy a house is when you find the house and the circumstances suit you. Don't try and game the system.
Yep.
You can't. It's like trying to buy stocks at the bottom of the market. All resources point to that is a fool's game.
Back to the Future with that sports book? Maybe. Of course, that's all like to buy Bitcoin at $10 a share or some shit.
You can't use a Back to the Future reference.
I already did.
We sound old. Yeah. Anyway, so best time to buy a house now.
Doc.
Don't do an impression of Doc. Do it.
No.
Okay. Well, now we have awkward.
All right. Well, thanks for getting awkward with me and diving deep. I talked to the entire time. I'm really sorry, but she's sick, so she needed to rest her voice.
No, it's fine. This is a you conversation. I feel this shit from a completely different angle. Like I said, I will find you the house that you can afford, but we may have to pick a different circle to give up. Right? For me, this is always the three circles: price, location, style, and condition of the house. Those are the three things you get. And when external circumstances change your buying power, your circles, the weight of the circles shifts.
Yes. When we bought our house, and probably when you bought yours, I bought based on price and location. The condition of the home was not great.
Less important. I mean, I know this isn't our topic for today, but I have seen consistently over the last, 8 years, the buyer appetite for sweat equity is really in the toilet. I feel like HGTV has given people, you would think that they would want to go in and do remodels and see how effective they can be, but what's actually happened is people want to buy the already HGTV'd house, and they walk into any house with 70s wallpaper and they go, ew, as though the wallpaper makes the house. It blows my mind because I'm walking into these beautiful floor plans and I'm like, what a deal. You can paint the damn thing.
Do you see all these closets?
Yeah. So maybe we can do an episode on what condition really means. I don't know.
Okay.
But manage your interest rate. Know your rate. Know your rate.
Yeah. It's not the end all be all, but it does affect the things.
Yep. Nice. All right. I think we're good. This was an interesting format. I don't hate it. I'm sorry that I'm sick. I'll be better
nice
next
doing
week.
it from home. All right. We'll see you later.
Bye.
Bye.
The info given is current as of this recording, but remember, the market changes and real estate is hyper local.